Now, let's consider the importance of valuation, how to avoid stock market bubble. How important is valuation, and how do you avoid stock market bubbles? Valuation plays a critical role in helping investors steer clear of stock market bubbles. A bubble forms when asset prices significantly exceed their intrinsic value, driven by excessive investor optimism, euphoria, speculation, or irrational exuberance. So, understanding the importance of valuation can help investors make informed decisions and avoid significant financial losses when the bubble bursts. Of course, the bubble will not remain forever. The bubble will certainly burst. As we saw the dot-com bubble, many years back. So number one is identify overvalued stocks. Put in the effort to identify stocks that are considered overvalued. Valuation metrics such as price to earning ratios, price to book ratios, and price to sales ratios, can provide a benchmark to assess whether a stock is trading at a reasonable price or not. So when these metrics are significantly higher than historical average, or industry norms, it may indicate an overvalued stocks, signaling the potential formation for a bubble. When stocks are overvalued, then correction will set in. The bubble will certainly burst because stocks don't grow to the sky. Eventually, they will have to revert back to the mean through a normal market correction or through a bubble, which could be detrimental to investors anyway. Number two is preventing herd mentality. Preventing herd mentality. During market bubbles, investors often follow the crowd, driving price further upward, without considering undervalued, underlying fundamentals. This kind of hard behavior, the crowd is never right. It's not always right. Investing is not a democracy where majority carry the vote. Sometimes you need to adopt a contrarian approach. So valuation, help investors maintain a disciplined approach, focusing on stocks' true worth rather than speculative, hype. Number three is mitigating risk of loss. Mitigating risk of loss. Stocks in a bubble are highly susceptible to price correction once markets, sentiment shifts. There must be a correction because they will at a particular point in time, be a shift in investor sentiments. The investors who rely on sound valuation principle can avoid purchasing overvalued assets, reducing their risk of significant losses when the markets adjust. The market will always adjust. We should bear it at the back of our minds as investors that there must be an adjustment. People will rush to take profits. Herd mentality will set in, and the market will then go back to its appropriate level. Number four is supporting long-term investment strategies. Supporting long-term investment strategies. Please don't forget to subscribe to this channel because there are wonderful videos that are there to improve your education as an investor. Because the more you learn, In this industry, the more you earn. Right? So subscribe to this video, to this channel, and like this video. So you talk about supporting, long-term investment strategies. In this context, valuation help align investments with long-term goals by ensuring that purchases are made at fair or discounted prices. Buy your stocks at a fair or discounted price because profits are determined when you buy, not necessarily when you sell. You buy at a cheaper rate. When you sell, you make a higher profit. If you buy at an expensive price, even when you sell at a higher price, you may not make as much gains as if you bought at a lower price. And this strategy provides a margin of safety, enhancing potential returns and protecting against volatility caused by market dynamics. Even if you made a mistake, because you bought at a sufficiently lower price, it will not cost you much. The blunder, the error will not cost you so much because you are bound to making mistakes anyway. But then, if you buy at a sufficiently low margin or high margin of safety, then you will not get your fingers burnt exceedingly. The impact may be minute. Number 5 is informing exit and strategies. Informing exit strategies. For investors already holding overvalued stocks, valuation analysis can serve as a warning sign to exit positions before a bubble bursts. For you to look at your holdings, look at your portfolio, and critically assess and analyze, how cheap or how expensive those stocks are. The ones that are very, very expensive are becoming overvalued. To sell them so that you not end up losing your money in a bust. So regularly assessing the intrinsic value of stocks allow investors to make timely investment decisions. So in conclusion, valuation is a vital tool for avoiding stock market bubbles. By focusing on the intrinsic value of stocks and maintaining a disciplined investment approach, investors can protect themselves from the pitfalls of speculative excesses and exchange or achieve more sustainable long-term financial success. So learn to know the intrinsic value of the stocks in your portfolio. It will help you so much when the correction sets in or when the eventual stock market bust sets in.